Away from Mumbai's hustle and bustle, Siva Subramanian prefers to be based out of his native Chennai. As a CIO of Franklin Equity at Franklin Templeton Asset Management, Siva feels staying away from Mumbai helps in removing clutter from investing life. His focus being spotting companies that are consistently profitable over time, something Siva has done successfully over a career spanning 2 decades. In fact, Siva stands out among peers in delivering consistent returns on his funds despite market cycles. An IIM Calcutta graduate, Siva oversees more than 13,000 crores of equity assets in schemes like Franklin Blue Chip, Franklin Prima and Franklin Prima Plus. A quiet and reserved person who enjoys reading in his leisure time, Siva is clear that the downturn is just part of a larger cycle.
I don't think it's anything new to India. We've been through these cycles in the past, and I think it's a repetition of that. Any economy would go through, ups and downs, and right now we are in a down cycle in terms of growth slowing down.
Are you worried about the rupee depreciation right now?
I think the sharp depreciation in the rupee is definitely a concern. Having said that, I think the rupee adjustment was overdue, and probably it has happened suddenly in a short period of time, but something which had to happen. It does give exporters, a leg up in terms of competitiveness, but I don't know how well, Indian companies are positioned to take advantage of the depreciation. The fact that, our imports are much more than exports means that, in rupee terms, our import bill has gone up that much more by 25% or so. Of course, to the extent that commodity prices have corrected, and almost 50% of the import basket consists of commodities like oil, coal, etc. The fall in these commodity prices to some extent negates the impact of depreciation. But having said that, I think it is too sharp, and corporate India probably is not prepared for such a sharp depreciation in such a short period of time.
How do global events influence your decision as a fund manager?
Global events influence us as fund managers to the extent that the flow of money into India can get impacted, and that can have a serious impact on performance of stock prices. But it's not going to have a big impact on the actual performance of companies. And our focus has always been to cut out the noise in terms of technical factors which impact market on a day-to-day basis, and focus more on the business aspects of a company. And if these global issues impact the stock prices, it may give us an opportunity to hold on or increase exposure to some of the better quality companies.
But doesn't the volatility kind of compel you to change or alter your conviction calls from time to time? I mean, what's the duration for which you keep your portfolio unchanged? If
you look at our flagship funds, the turnover ratio is around 50% or so in funds like Blue Chip and Prima Plus. So obviously we take much longer term calls relative to some of the peers. And so the short-term pressures really don't impact the portfolio calls. We have seen global growth slowing down. The US has slowed down quite considerably. Europe obviously is in need of another injection dose of liquidity. So all indications are that we may have another QE3 sooner rather than later, and that is likely to fuel another rally in many of the so-called risky assets.
And you see that happening, let's say, by the end of 2012, early 2013?
Well, the way global economies have weakened in recent times, it looks like it will happen sooner rather than later.
What are you doing in the market right now? I mean, what are your sectoral or stock preferences at this point?
Like I mentioned earlier, we normally don't take these top-down sectoral calls. It's more focused on individual companies and bottom-up calls. Having said that, we have been quite positive on sectors like telecom, which have not done too well in the last 2-3 years on account of regulatory issues. We have a fairly big overweight position on sectors like telecom.
Despite the controversy there?
Well, probably because of the controversy. I think the valuations have been quite low on account of these controversies, and it's given us an opportunity to build fairly big positions in these stocks.
So what's your approach to the market? Are you looking at contrarian themes like the one you just pointed out in telecom? Are you looking at value themes, or are you looking at stocks which are commanding a scarcity premium?
We are style agnostic. We have a combination of growth-focused stocks, value stocks, as well as some exposure to sectors like FMCG. Having said that, right now, if you look at our portfolios, we seem to be underweight on the FMCG theme. That, to some extent, explains our position.
Have you booked profits in FMCG and select pharma companies?
We have, to some extent, reduced exposure in select FMCG companies. As far as the pharma sector is concerned, we still are extremely positive. We have, in fact, increased exposure to the sector recently.
What about momentum sectors? What about the traditional sectors which are linked to the investment cycle, infrastructure, construction, cap goods? We've also seen a fair amount of interest come back in real estate, purely on the basis of analysts expecting that the selling has been overdone in the sector and perhaps there could be a turnaround in the offing. What would be your approach to these sectors?
I think each fund house has its strengths and weaknesses. We are not extremely strong on some of the sectors you've mentioned in terms of understanding them and investing and making money in them in the past. So we've sort of shied away from quite a few of these sectors. Having said that, we do have fairly significant exposures in the capital goods space to companies like, for example, Cummins, and these have been core holdings in some of our portfolios for a long period of time.
What have you made of the kind of controversy that's hit the cement sector right now with the CCI order?
I think it's a fairly draconian kind of an order, and cement as a sector has not been extremely profitable over the last decade or so. It's only a few years when the whole sector as such has made profits. I think the order will be tested in court, and whether there was a cartelization or something has to be proven. The order, if I understand correctly, has not provided concrete proof of cartelization, but if the order is upheld, I think it is extremely negative for the sector.
I observe that you have concentrated portfolios across your funds, with the top holdings having an average weightage of about 7 to 8%. What's the rationale behind such a portfolio strategy? Is it capital protection, or just essentially you believe that there is still growth in some marquee names?
Well, I think it's the latter more than the former. We tend to have a diversified portfolio, but having said that, we have fewer names in our portfolio compared to some of our peers. The aim is to, put more money behind stocks where we have high conviction, and the upside potential is quite high.